Stocks and bonds climbed throughout October, with monetary policy and strong earnings reports leading the way. Both the Bank of Canada and the U.S. Federal Reserve cut interest rates by 25 basis points at their most recent meeting, but their forward guidance was less inspiring. Having already lowered rates by nearly 3% since June of 24, Canada's central bank signaled a pause before going further. Unsurprisingly, the message seems to be that monetary policy can only do so much to soften the blow of trade disruptions. Fiscal support is now better suited for the job. What was more unexpected was the Fed's decision to so quickly dash hopes for another cut in December. The U.S. government shutdown has led to a scarcity of economic data, complicating their job. The good news is that global interest rates are trending downward, but we may not have much lower to go this cycle. Roughly 75% of U.S. and 20% of Canadian companies have reported earnings this quarter, and they've generally surprised with an average 15% rise in year-over-year profits. Gains continued to trend toward the technology sector, thanks to sustained growth in cloud computing and heavy investment in AI infrastructure. Some have started to question valuation levels for the tech titans and whether eventual returns can size up to capital expenditures. The CEO of Microsoft recently flagged another potential concern. The primary bottleneck for AI development is not the supply of advanced semiconductor chips, but rather the lack of reliable energy production available in close proximity. This is good news for companies with a diverse set of power sources, both traditional and clean. Google, Microsoft, Amazon, and Meta have all made moves to secure reliable supplies as close as possible to key data centers. Nuclear power, in particular, appears to be making a renaissance in North America. This resurgence has benefited several companies that we've invested in: Cameco, Brookfield Renewables, Aecon, and NextEra Energy, just to name a few. Our investment team continues to look for other opportunities in the transmission and distribution of electricity. We've also capitalized on a number of investments in data centers themselves within Bellwether's Global Real Estate and Infrastructure Fund, most recently in underserved European cities. Investing in infrastructure was a key theme of the Liberals' first budget under Prime Minister Carney this week. In fact, the budget deficit is expected to soar to nearly $80 billion due to a series of tax cuts and spending initiatives designed to encourage private sector investment. Adding hundreds of billions to national debt over the next 5 years is certainly concerning and likely unpopular, given that nation-building projects will take years to come online. On the other hand, the case can be made that now is a reasonable and even necessary time for our government to borrow more money to support our struggling economy. Trade talks with the U.S. have stalled due to Ontario's anti-tariff commercial that irked President Trump, and likely puts the renegotiation of the U.S.-Mexico-Canada trade agreement under additional strain. Thankfully, Canada is rich in high-demand natural resources. The systems to extract, refine, and export them have been neglected for decades. Initial reactions to the budget have been mixed, and the Liberals still need the support of one opposition party to get it passed. If they can't curry favor, an election will be called. The Conservatives and Bloc seem unlikely to move it across the finish line, and the NDP is concerned about aggressive cuts to the government workforce. We should find out on November 17th if Carney's ambitious budget will move ahead or not.